So one of the most important things about saving your future is that once you learn the secret of wealth building, that's what's missing in most people's structure today. They don't understand the concept of wealth building, and that's what we have to spend more time on, learning the secrets to wealth building. That's why I said, if you ever want to hide the secret, they put it in a book because most people won't read it today. So one of the things that we have to do is that we got to get really good at reading. That's why we provide you with 2 books that helps you with that. The workbook, the one on the left, that one teach you in our workshops that we give you access to. These are complimentary workshops to anybody that wants to participate in them. And then we give you the blue book, which is your finance 101. This book teaches you how to save your future. It teaches you the basic principles of how to build a financial foundation. And once you grasp the concepts in these things, you too will learn some of the most important secrets that was kept amongst in finance that was not given to you. So, like I said, I'm not here to talk about the problem. I don't want to talk about the problem. I'm here to talk about the solutions. So I don't want you to feel that this is going to be one of those things we're going to talk about the problem all the time. No, today we're going to give you real solutions. And that's important for you to understand, and it's you to take really good notes on this. So the first thing I want to talk about is this concept, the 3-legged stool concept. This was given to our baby boomers. So you probably go to your grandpa and ask them, or your grandma, and say, Grandma, you remember the 3-legged stool? This was the concept that was created that they should have 3 income during their retirement. They should have some money from their personal savings. They should have some money coming in from their company pension, and also money coming in from Social Security. And this should be happening during retirement. So that's when the good old days, right? Where we talked about pensions. How many of you guys that's looking at this, watching this, have pensions? And if you don't have a pension, then this is something that you got to think about. Because they talk about the good old days of pensions, and they're disappearing in North America. They talk about the fact that in the U.S., companies now offer 401ks and few match contributions. The same thing is happening in Canada, where companies have moved, they've been moving away from defined benefit plans and actually provide a known retirement amount in the time of retirement, and now they're pushing you into defined contribution plans that leave the investment risk with the workers. The reason why most companies are doing this these days is because people are living too long. So it's expensive for them to provide you income until you die. So what we must do, we know that's one of the problems, is the fact that companies are not giving you pensions anymore. So then we're going to take a look at what's going on. It says, according to a recent survey, North Americans are facing serious financial challenges. And some of these challenges are the fact that in the U.S. it's even gloomier. They talk about the fact that 33% or more than 77 million Americans don't pay their bills on time. They said that 39% carry credit card debt from month to month, and only 59% of adults say they have savings. Worse, more than half now think it's acceptable to default on their mortgage if they can't afford to pay it. So I think the question that you got to ask yourself is, how many people we know going through this every day? How many people in your circle is going through this every day? Who's helping them? Who's giving them the solutions? If it's that answer is nobody, then that's where we could be your solution. Our company could be your solution. Our workshop could be your solution. Our financial literacy campaign can be that solution. Because we don't ask you to buy anything. We don't ask you to pay for anything. Our crusade is to educate 1 million families by the year 2020. You are a part of that crusade right now. So one of the things that we got to think about, we got to think about the financial foundation. How do you build a financial foundation, or what does that mean? So it's like building a house. You should start with a solid financial foundation and build it from the ground up. Now, what do I mean by this? Let me break it down. So when you're building your house, first you should have proper protection in the event of disability, health problems, or premature death. This is the first foundation to building your financial foundation. You got to create protection for all of these things. Then the next thing is debt management. You should reduce your liability and get out of debt as quick as possible. Then the next one, emergency fund. You should set aside 3 to 6 months of your income to deal with sudden changes in your job or business, or to pay unforeseen accidents or repairs. And then last, investment. You should invest. And when you invest, you got to invest for the long run. You see, the thing that you got to understand is that all these tasks should be taken care of as soon as possible. You must take care of these tasks as soon as possible. You can't wait. Because if you don't start creating your financial foundation, then you're not going to be in the position to understand how money works. And for you to understand how money works, you must understand what is the wealth formula. You see, the wealth formula requires you to have money. And then your money requires to have time. The time it gets with the right rate of return. And the reason why is because you got inflation and taxes that are going to take away money from your money. And whatever is left over is wealth. Now, here's the thing that we have to understand. Everybody on this call watching this right now is wealthy. You're very wealthy. The problem with your wealth is not that you're not wealthy. It's just that it's not enough to give you the lifestyle you desire. But you're wealthy. Because after your money got time and the type of interest you get on it, inflation and taxes take their cut. And then you got to think about the fact that whatever's left over is wealth. You're just not the wealth that you desire to have. So where's the money? A good number of people always seem to have money problems. Did you know that most of the time they're short on funds? And Warren Buffett advises to don't save what is left after spending, but spend what is left after saving. That's the reason why today you're going to learn about the wealth formula. And I'm going to break down how this wealth formula works for you. So the first thing we got to talk about is that you got to pay yourself first. You got to put yourself in a position where you pay yourself first. So the way you pay yourself first is that you need to set aside 5 to 10% of your income and save for the future. If possible, save 15% or more. So you got to treat this like a bill that you must pay, and you got to pay it first because that's your family's financial bill. Doesn't it make sense to pay your family first before you pay other people's bills? Your cable TV is not more important than your family's financial well-being. That's why you got to make small changes if you want big money. Small changes will bring you big money in your retirement. So here's the thing. Spending is a habit. We all know that. But so is saving. What if you can make small changes to your spending habits and actually start saving $10 a day? That's $300 a month. So if you were to save $300 a month and you get 8% interest on that money in 30 years, you'd have $447,000, 107. My question to you is, did you know that's not enough for retirement? Is that good money for you to retire on? How long is that going to keep you in retirement? Here's the next thing. What if you were disciplined and you save $20 a day, $600 a month, get the same 8% interest on your money in 30 years? That gives you approximately $894,214. Did you know you need at least this much or better in order to stay retired and have a comfortable retirement? And the reason why is because the cost of living keeps going up. So the next thing we're going to talk about, if you figured out about how to pay yourself first, then you have to spend the time to, you got to master budgeting first. You got to spend time to master budgeting first. The example we're going to use is a net pay of $3,000. So the formula we use to do our budgeting, we're going to teach you how to use the 50-20-30 formula. And this formula is very effective if you know what to do. So the way the formula works is that you got to break down all of these things. When you look at your finances, you got to think about what is your monthly bill. So in this example, let's just say that your monthly bills are $2,400 a month. This is your bills. So the 50% should go towards that. 20% of your income should go towards your savings. So you're saving $100 a week out of your money. And then for spending, let's say that the average person spends 30% of their income, which is $10 a day. So now, how the formula works? Once you figure out what is your total monthly bill, and you know what is your net pay, then the formula works like this. In this example, we talk about net pay being $3,000. You're going to take a net pay times it by 0.50, which represents the money for the bills, and that gives you $1,500 in this example. Clearly, you can see that's not enough to pay the bills. So then you got to continue. You got to look at how much you could have for savings. So now you're looking at your retirement money. You take your net pay, times it by 0.20, that gives you $600. So right there, you realize that you have $600 for retirement. You can put towards it on a monthly basis. And then you have the spending money. 30% of your net pay is $900 in this example. So right there, this person is spending 3 times the amount than the average. You see, most of the time when you see yourself can't pay your bills or you're struggling paycheck to paycheck, the key to everything is that you either have too much unnecessary bills or you're spending too much money on a monthly basis. So this is formula that helps you to stay on a budget. So if you know that based on your net pay and your monthly bills, you know that each month you're in a position to not be able to spend a certain amount of money. Because if you look at this example and you see you got 2 choices, you can take it from your retirement or you can come back and you spend it. What you don't want to do is take money from your money that you're saving for your retirement and apply it to bills. You want to come back on the spending and apply that to the bills. Because if you did that in this example, you have enough to pay the bills. And you still be able to retire and save towards retirement. So once you figure out how much you can save, then it leads me to my next conversation, where we talk about the rate of return, the magic of compound interest. This is the third step in the wealth formula. So once you understand the fact that you got to learn what's called the rule of 72. And the rule of 72 says you're going to take 72 divided by the rate of return, and the answer is the number of years it takes for your money to double. So this is what the formula looks like. So when you look at this formula, I want you to write this down. This formula says 72 divided by whatever rate of return. So the rate of return is whatever interest you're getting on your money or against your money too. That will equal the amount of years it takes your money to double for you or against you. And this is very, very important for you to know. So here's the thing. We're going to show you 3 examples of how interest have an effect on your money. The first one I'm going to share with you is if you had a 4% interest on your money. 4%. So let's say that you're 29 years old and you put away $10,000 one time. And say, you know what, I wanted to put away the $10,000 one time, and by 65, I'm hoping that it will grow to where I have enough money. So what you got to do, you got to take 72, you're going to divide it by that 4 for the 4%, and that equals 18. That means your money will be doubling for you every 18 years. So from 29 to 65, your money have only doubled twice. How is $40,000 for you in retirement? What if you was able to find 8%? 72 divided by 8 equals 9. Money doubling every 9 years. So from you look at it, from 29 to 65, your money have doubled 4 times. But now let's take a look at another interest. What if you was able to find 12%? 72 divided by 12 equals 6. Your money doubling every 6 years. So now your money is doubling 1, 2, 3, 4, 5, 6 times. Your money have doubled 6 times from $10,000 to now $640,000. Now, did you know the difference between your $10,000 at a 4% versus a 12% is actually $600,000? And that $600,000 is actually equal to a 20-year salary of someone who earns $30,000 annually. See, what you learn is that you need to get yourself in a position where you can earn 12% or better earning potential on your money. Because that's the only way you're going to be in a position to keep up with what's called inflation. That's the only way you're going to be in a position to keep up with inflation and taxes. So let me talk to you a little bit about what is inflation. Now, inflation is known as the silent killer. So when you think about inflation, I want you to use the word silent killer. So what do I mean? I simply mean that inflation is the rise in price in goods and services over time. That's what inflation is. That means that if you used to pay $1 a gallon for gas and it's now $4, that's what inflation is. If milk was $2 today and then it became $4 later on, that's what inflation is. So these are the different things about inflation. Now, here's the thing. Inflation is a major factor to consider when you're building up your financial future. And it says, for instance, if you put money in an account with a 0 rate of return, the value will certainly decline in the long run. So in the last 100 years, you got to think about the fact that in the last 100 years, from 1914 to 2014, the U.S. inflation rate averaged 3.32%. Can you imagine that? It averaged 3.32% right now. So what does that mean when it comes down to your retirement? It means that, say you plan to retire with $4,000 coming in as an income per month in today's value. Did you know 20 years later, at a 3% inflation rate, you need to have $7,224 in order to still enjoy $7,200, to enjoy $4,000 as far as a buying power for you? Do you realize that that's pretty much over $3,000 more you would need? What if you don't save enough? What if where you're putting your money right now, where you invest in your money, is not the right place to get the right type of interest for your money? That's why you have to learn these things. Because if you don't understand inflation, then the next thing on our topic is taxes. And Benjamin Franklin said it best. He said there's nothing certain in this world except for death and taxes. So imagine the fact that you're going to make money and they're going to tax you. You're going to spend your money and they tax you. You save money, they tax you. You die, they still tax you. That's how taxes are set up today. So we have to learn the fundamentals of how to learn the 3 ways our money gets taxed when we need it. There's 3 ways your money gets taxed when you need it, when you withdraw it, and when you want it for your retirement. So where does your money go? That's why today we're going to take a look at the different tax treatment that your money and your investment gets in the U.S. Where do you put your money? Did you know that 85% of the population put their money in what's called tax now? Tax now vehicles are checking, savings, CDs, stocks, and mutual funds, which pretty much means that any earnings or dividends that is gained on these policies in these plans or these savings investments, any earnings from these in a year, you must report and pay taxes on it. That money is called taxable money. Then on top of this, you got something that's going to tax you later on. Your 401k, 403bs, IRAs, SEP IRAs, annuities, and pensions. These money is considered to be called tax deferred. And tax deferred pretty much means that your money is pre-tax. And pre-tax money is money that you didn't pay taxes on yet, but you'll definitely be paying taxes later on though. Did you know that these plans actually have rules? And the rules are, if you are 59 and a half and you start withdrawing the money, because that's the qualified age to start taking the money, your withdrawals and any money that comes from this will be taxed as ordinary income. And then if you fail to follow those rules and you took it before 59 and a half, they're going to penalize you 10% in addition to paying taxes. Also, you can't keep your money there forever because you must start withdrawing it when you reach 70 and a half, or you're going to pay a 50% penalty because you failed to take out the required minimum distribution. 10% of the population put their money there. 5% of the population use what's called tax advantage. And tax advantage is in your Roth IRA, 529 college savings plan, municipal bonds, health savings account, life insurance, long-term care. These vehicles get tax exempt distribution. Now, what is tax exempt, you're wondering? Tax exempt pretty much means that the money you put in is pre-tax. That means you're going to pay taxes on it going in. You're going to pay taxes going in. And then when you time to withdraw it, you don't pay taxes on the withdrawal. So because you pay taxes going in, when you take it out, you don't have to pay taxes on the withdrawal again. That's why 5% of the population learned about tax advantage, and that's what we want to do. We want to educate families on where to get these type of tax advantages. So now that we have covered money, time, tax rate, right, the interest, the inflation, all these things, let's take a minute to do a quick little quiz. And the first thing I want to figure out is this. I want to help you figure out when you're building your future and you're making financial decisions, you should ask yourself these questions. Here are the questions you got to ask yourself. Wherever you're putting your money right now, ask yourself these 4 questions. Number 1, can it potentially grow to achieve your goal? Number 2, is it safe enough? Number 3, does it get tax advantages? Now that you understand what tax advantage is. Does it have proper protection? Wherever you're investing your money, can you answer yes, 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 yes to all 4 of these questions? And if you can't answer all yes, then that's a reason why you need to sit down with the person that showed you this or whoever invited you. So that way you too can learn the fundamentals of how to prepare yourself for this. How about this one? If you have a good answer to each of these questions, you're likely moving in the right direction towards your goal. But growth is good. But until you learn how to manage your growth, then things will get better for you. But managed growth is way better. Most of the time, we don't know where to put our money to get all of these things. But there is a vehicle where you can put your money and have all of these things, and that's what I'm here to share with you. Now, the first thing, before we even tell you how the vehicle works, you got to think about this. What's more important to you, growth or safety? But the question should really be, why should I choose? Why should you choose? Why can't I have both? Why shouldn't it be both growth and safety? Why do I have to make a decision of which one is better for me? So the way this vehicle works is that if the stock market goes up, the growth potential you have in this vehicle is actually 15%. If the market goes up, you could earn up to 15% as a cap, as a ceiling. That's the most you could earn inside of it. But if the market goes down, if the stock market crashed tomorrow, or it corrects itself, the safety that you have is 0.75% as a floor. That's a guarantee. So if the market goes down past 0 in a negative, you're getting a positive. So right there, I'm showing you, not only do you have growth potential, but you also have safety. But what else you get? Protection. You get protection for if something happens to you. If something happens to you, you get what's called a death benefit. Your family gets the death benefit. But if during your lifetime, it also protects you against terminal illness, critical illness, and chronic illness. If something happens to you, money will be there for you in that crisis. How about the tax advantages that you get? You get tax-deferred growth, tax-free withdrawals, and tax-free loans, and tax-free death benefit that goes to your family. Now, you're probably wondering, what is this vehicle? Well, let's talk about something that no one wants to tell you. Let's talk about the tax advantages of life insurance. Because you probably thought that life insurance is for when you die. And it's not. The word life insurance should tell you what it's for. It's for when you're living. Final expense insurance is for when you die. But the right life insurance can be used for when you're alive because of this. Under the Internal Revenue Service, which is the IRS, and even the Canadian Revenue Agency, which is CRA guidelines, insurance policies receive many favorable tax advantages. Did you know that? Did you know that your family will get a tax-free death benefit? Should the insurer die, the entire death benefit, including the cash value, is income tax-free to the beneficiary. Did you also know that you get tax-deferred earnings, where you do not pay taxes on the gains in the policy? Did you know that the tax is deferred until you decide to surrender the policy of lapse, or when a certain distribution occurs? Did you also know that you get tax-free withdrawals? When the cash value in the policy is sufficient, the premium that was paid into the policy can be taken out as a tax-free withdrawal up to the cost basis in the policy. This is the premium you paid with after-tax dollars, so you get back what you put in. And also, you get tax-free loans. So besides the withdrawals, you can take out more money out of the policy in excess of your basis, which means your premium paid. So through tax-free loans with a very low net effective rate. This is powerful for anybody that wants to learn how to definitely take advantage of how to create another retirement supplement. How about Social Security? Do you understand Social Security? Did you know that Congress established Social Security Act in 1935 to help supplement the income for retirees? But unfortunately, Social Security has become the only source of income for millions of Americans today. Now, what does that mean? It pretty much means that Social Security is funded by current payroll taxes, which is known as FICA. So from your employer, right? Now, this is the thing you gotta understand. The shrinking pool of workers per retiree will be challenging the system that was created for baby boomers and many, many people after this. So what are the charts for your retirement? Did you know that the following chart lists below for retirement age by your birth? So these are the age you can receive the full Social Security benefit. So if you were born in the year of 1943 to 1954, for you to receive your full retirement or full Social Security benefit, you have to be 66 years old. Now, did you realize that the ages gone up? So if you were born in 1960 and later, you have to wait till age 67. So note, people who were born on January 1st of any year should refer to the previous year. But one of the things that I realized is that this whole 65 notion is not so much of a 65. As you can see there, it is 66. So this is something that we got to think about when we think about retirement and depending on Social Security. So what about estate planning? Do you have your estate in order? You know, most people think that estate planning is for rich people who live in mansions up on the hills. But in fact, everyone has an estate. Your estate is everything you own minus your debt, such as your house, car, money in the bank, and your family belongings that you want to pass on to the next generation. How about the fact that imagine you work hard your entire life and build up an estate, and you want to pass it on to someone, but in the end, it ends up with someone else due to the lack of planning. That's why a will or a trust is a tool for you to organize how you want your estate to be distributed when you pass away. So my question to you is, do you have a current and updated will or a trust to protect your final and current decisions? Do you have all these things in order? So every Tuesdays and Thursdays at 7 p.m. and Saturday at 12 p.m., we provide financial workshops for anyone who wants to learn more about building an estate planning. If you want to learn how to build wealth and put together your estate planning, the workshops are here. Because in our workshop 1, we're going to teach you how to increase your cash flow and how to manage your debt. Workshop 2, we're going to teach you about how to build a financial foundation and how to put together proper protection for you and your family. Workshop 3, you're going to learn about how to build wealth and how assets accumulate. And then workshop 4, we're going to talk about retirement planning and how to preserve your wealth. And workshop 5, my favorite, you'll learn how to build a business in the financial industry. So I want to encourage you to take advantage of our complimentary financial literacy workshops and the budgeting planning. That is what's really, really incredible. And we want you to take advantage of this. So here's what we want to encourage you to do. Please save your future. And the way you save your future is by putting together a plan of action. That's why we want to encourage you to read your Saving Your Future book. So that way you can learn the basic principles of how to build a financial foundation. You see, you can make change. You see, you got to take charge of your future. And the way you take charge of your future is pretty much one of the greatest miracles in life. And it's all because you got to take a simple change in your mindset. You just got to change your mindset. You see, a common secret shared amongst highly successful people is the way they think. And you got to think and grow rich, because many of them come from the same place where we are today. And guess what? They made it big because they read. You could read your way to success. You could learn the successful things as well. So here's my thing. Did you know you're one decision away from changing your future for the better? So I want you to always remember that the choice is yours. The choice is yours. So here's some life choices. Are you ready to learn about finance? Because if you are, I have something to ask you. Life is about choices, right? And the thing you got to think about is this. What will your future look like 5 years from now? Think about that. What will your future look like 5 years from now? Did you know you have the tools, the power within our financial campaign, within our company to change that? And the way you could change that is simply one. You could save your future by doing the following. You can learn how money works with us. You can make some extra income on a flexible schedule with us. You could get rid of your debt, and you could save for your children's education and your retirement by learning with us. Then you could also even build your future with us. You could transition in this exciting career in the financial industry. You could potentially build up residual income and financial security with renewals, trails, supervision, and override incomes. You could build a team. I like to say you could build a family here. So be a part of something big. You could build a large organization all over the U.S. and Canada and just educate and help thousands of families. So I want to leave you with a powerful quote, and it's by Bill Gates. And he said that if you are born poor, it's not your mistake. But if you die poor, it's your mistake. I want you to take the time to really look into some of the information that we shared with you and see yourself doing something big. Because before I started this campaign, I used to work 3 jobs. I used to work from 3:45 in the morning to 11:30 at night. I did that for about 5 years until my cousin called me and said, come check out this opportunity. And I came down and I checked out the opportunity, and I started on a part-time basis, and I started learning how to put together things for me and my family. You know, one of the greatest things that motivated me to get started is the fact that I wanted to make sure my kids never have money problems like I did growing up. And I wanted to be in a position to retire my mother. I'm very thankful that this campaign have given me the tools, the knowledge to do both of these things. And you know what? It could do the same for you. So I encourage you to take advantage of this information. Take an action to change your family's future. Because you're always one decision away from changing your future for the better. And yes, it's a choice. Being broke and rich is a choice. And you have the decision to change that. So I hope you make the right decision and definitely take an action of change and choose one of the following. You want to start with saving your future first? Do you want to start with building? Or you want to be number 3? Once again, why should you have to choose? Why not do all 3? So thank you for definitely tuning in. I hope you learned a lot of good stuff. And I hope this ain't the last time we get to hear and see you. I appreciate you. And I look forward to doing great things with you. All right. Thank you. Bye-bye.